I want you to imagine you're looking at a brand new, just gleaming high-speed train.
Oh, I like this. Okay.
Yeah, so it's moving at like 300 miles an hour.
Mm-hmm.
The engineering looks absolutely flawless. The momentum is breathtaking. And, you buy a ticket because literally everyone tells you it's the future.
Right.
But what you can't see from your window seat is that the tracks are actually being built just a few feet in front of the train as it moves. And they're using, like, borrowed steel.
Which is a terrifying thought.
It's structurally terrifying. And that terrifying structure is exactly what we are dissecting today on this deep dive. Because we've pulled a massive stack of financial and technological research to figure out if this trillion-dollar AI infrastructure build-out is actually a durable foundation for the future, or if it's just a precarious financial bubble that's, waiting to pop.
Yeah, and the stakes here really cannot be overstated. I mean, we are looking at probably the defining economic question of this decade. Because the scale of capital being deployed into these AI data centers right now it's genuinely unprecedented. And to keep that train accelerating, like in your analogy, the track layers are having to borrow even more steel just to keep it from completely derailing.
Yeah, but we do have to start with the bull case, right? Because
Yeah.
honestly, the momentum is undeniable.
Oh, absolutely.
When you look at the recent market intelligence on these long-term agreements or LTAs, the demand is just voracious.
It's everywhere.
Right. We're seeing companies like Intel and AMD signing these massive multi-year CPU agreements with Chinese customers, specifically for AI data centers.
And the pricing data on that is wild.
It really is. To give you an idea of the heat in this market, prices for some CPU products in China are up like over 40% since the start of the year.
Yeah.
And we're talking month-on-month increases topping 10%. And it's not even just CPUs, right?
No, not at all. You're seeing the exact same thing with memory.
Exactly. We're seeing similar locked-in, what they call take-or-pay contracts, spanning multiple years for memory with giants like Samsung and SK Hynix,
Yeah.
and even in photonics.
Yeah, which is kind of the backbone of all this data transfer.
Right. So, okay, let's unpack this for a second. When you have the biggest companies in the world locking in uncancelable multi-year purchases, it makes it really, really hard to buy into the whole bubble that pops narrative because the money's literally contractually guaranteed.
Well, yeah. I mean, what's fascinating here is that those contracts do look incredibly solid on paper.
Right.
Because a take-or-pay agreement means exactly what it sounds like, The buyer either takes the hardware or they pay a massive financial penalty.
So the supplier is happy.
Exactly. From the supplier's perspective, that revenue is locked in a vault. But to understand the real risk here, you have to look underneath those contracts at the underlying collateral.
Okay, what do you mean by that?
Well, the tech sector is pretty much the engine of the global economy right now, right?
Right.
And the capital flowing into these physical data centers is its primary fuel. But there is a very, very dangerous timeline mismatch in how the physical assets sitting inside those data centers, specifically the GPUs, are actually being financed.
Oh, man, I want to dig into that mismatch.
Yeah.
Because the numbers in this data center project finance report we looked at are just staggering.
They really are.
There is this massive capital expenditure chasm. So we're looking at tech giants, the hyperscalers, and they're projected to spend $332 billion on AI capital expenditures in 2025 alone.
Just an astronomical amount of money.
Right. But here's the kicker. Their actual AI product revenue for that exact same year is estimated at just $28.7 billion.
Yeah.
I mean, that is a $300 billion gap between the money flying out the door to build this infrastructure and the actual cash coming back in from selling AI services.
And that chasm is really the central tension of the entire industry right now. And, it becomes a systemic issue when you factor in the physical degradation of the assets they're buying.
The chips themselves.
Exactly. So historically, a company like NVIDIA, they released new cutting-edge chips every 2 years.
Right, the standard cycle.
Right. But now,
Yeah.
they've shifted to this grueling yearly release cycle. And the moment a new generation of chip hits the market, the older generation just immediately loses its pricing power.
Because everyone wants the fastest toy.
Exactly. I mean, you can rent last year's flagship H100 chip right now for a fraction of what it cost just 12 months ago. It is essentially a depreciating rock.
Wow.
But to make their balance sheets look healthier to investors, a lot of these tech companies are doing something sneaky. They're stretching their accounting depreciation schedules.
Okay, wait, explain how that works.
So they used to write off these servers over like 3 or 4 years, but now they're stretching that out to 5 or 6 years.
Right, so they are essentially claiming on paper that this enterprise hardware holds its premium value for 6 years.
Hmm.
Even though we all know that, Moore's law on steroids is rendering it functionally obsolete in 12 months.
Exactly. It is entirely an accounting fiction just to keep their quarterly earnings looking good.
That is wild. But here's the piece of the puzzle that really stood out to me from the reports. It's the timeline clash.
Oh, yeah. The financing timelines are a mess.
They really are. According to the research, retail data center leases are signed for like 1 to 3 years.
Hmm.
But the loans taken out to buy the GPUs inside them are 3 to 5 years.
Right.
And this is the crazy part. The term loans that the developers take out to build the physical concrete and steel data center buildings, those are 10 to 30 years.
Yeah, 30 years.
So what does this all mean? I mean, it's like financing a smartphone on a 5-year loan, even though a better phone comes out every 12 months that makes your old one worthless.
That's a perfect analogy.
So if everyone in the financial sector knows the tech degrades this fast and the leases are this short, why on earth are sophisticated lenders writing these massive 30-year loans?
See, that is the exact paradox that reveals how this market is actually operating right now. Because lenders aren't just underwriting the physical asset anymore or, the long-term utility of the building. They are relying on a market structure that has basically evolved into a closed loop.
A closed loop.
Yeah, it's a phenomenon known as roundabouting or circular financing. And the highly incestuous nature of these financial deals is actually masking the true leverage and risk in the system.
Yeah, when I was reading the reports on this roundabouting stuff, the math seemed incredibly incestuous.
Very much so.
You've basically got companies passing the exact same dollar back and forth to inflate their valuations. Like Oracle, for instance.
Yeah, the Oracle deal is a great example.
All right, so Oracle is spending $40 billion to buy NVIDIA chips. They're putting those chips into a Crusoe data center. And then Oracle is turning around and leasing that exact same capacity to OpenAI for an astonishing $300 billion over the next few years.
Yep.
Meanwhile, OpenAI is also using AMD chips, but the reports note that they are financing them through these special purpose vehicles, or SPVs, to basically hide the leverage.
Right.
How does an SPV actually accomplish that? Like, what is the mechanism there?
So by putting the debt into a special purpose vehicle, which is essentially this legally distinct little side company created just to hold this specific hardware, and the debt attached to it, the parent company gets to keep that massive loan off its main balance sheet.
Wow, okay.
Yeah, so to a casual investor or even like a secondary lender, the main AI company looks incredibly cash-rich. They look debt-free.
But they're not.
No. In reality, they are deeply on the hook if that SPV fails to generate revenue. They are just compartmentalizing the risk so they can take on more of it.
And it doesn't even stop with just spinning up side companies. Look at the neocloud providers. Companies like CoreWeave and TeraWulf.
Oh, yeah.
The report notes TeraWulf is floating $3.2 billion in junk bonds, but those bonds are being guaranteed by Google.
Right.
And Microsoft represents over 60% of CoreWeave's entire revenue stream. And then NVIDIA, the company literally manufacturing and selling the chips, is committing to buying CoreWeave's unsold compute capacity.
It's all connected.
Here's where it gets really interesting to me. It's like a group of friends who are all co-signing each other's mortgages.
Yes.
On paper, everyone looks incredibly creditworthy because everyone has this wealthy guarantor.
Mm-hmm.
But if one person in the friend group loses their job, the entire neighborhood goes into foreclosure.
That's exactly how it works.
So is there any actual new consumer money coming into this system to pay for all this? Or is it just the same tech money bouncing around in a circle?
Well, that risk mutualism is exactly what the industry is relying on right now because currently there's about $1.2 trillion in debt tied up in AI.
Trillion.
With a T. With a T. And a huge chunk of it is obscured by these cross-collateralized agreements you just mentioned.
Unbelievable.
So as long as equity values in the stock market keep rising, these companies can just keep borrowing against their own perceived wealth to fund the next purchase.
So they're just propping each other up.
Exactly. They're propping each other up to artificially sustain the demand curve. Which really brings us to the ultimate reality check on whether this loop can actually sustain itself.
Yes, exactly. And I want to bring in this brand new July 2026 quantitative paper from Riken on AI industry restructuring.
Such a crucial paper.
Because this paper, it maps out exactly how narrow the path to survival actually is for these interlinked companies. They refer to it as the solvency corridor.
Yeah, the solvency corridor is just a fascinating metric.
Break it down for us.
So the Riken paper calculates that for this massive mountain of interrelated debt to actually be paid off without triggering some kind of systemic default, the industry needs aggregate token demand to grow by 2x annually for 4 straight years.
4 years of doubling.
Yes. And simultaneously, premium pricing for closed AI models must remain at its current high levels.
Wow.
So if they miss either of those targets, like if token demand only grows by 1.5x, or if pricing power drops even a little bit, the entire industry essentially exits that solvency corridor.
And when we say token demand, just for you listening, a token is basically a piece of a word that an AI processes. So a 2x annual growth in token demand means the actual functional usage of AI by everyday people and businesses has to double every single year for 4 years just to keep the lights on.
Right, it's a huge hurdle.
But the Riken paper also highlights this massive structural advantage that makes this corridor even narrower for new startups, right?
Oh, absolutely.
They point to the recent surge in DRAM and HBM memory prices alongside these new efficiency games like TurboQuant KV cache compression. And they say the big players who already have sunk infrastructure are heavily protected by this. So what exactly is the mechanism giving them that edge?
Well, to understand the edge, you really have to look at the hardware bottlenecks. So HBM, or high bandwidth memory, is basically this massive superhighway connecting the AI chip's processing brain to its memory banks.
Okay.
It is incredibly expensive, and right now it's in very short supply. And then you have KV cache compression, which is a software technique. It allows an AI model to remember previous parts of a long conversation without requiring extra computational power.
Oh, wow. So they don't have to reread the whole chat every time.
Exactly. So the established hyperscalers, they already own those physical superhighways, and they've already integrated these advanced compression techniques into their proprietary architecture.
So they're just way more efficient.
Way more. They can process those tokens vastly cheaper than anyone else. In fact, the paper projects that by 2030, these established players will have a 4x cost advantage over any new entrant trying to build a greenfield data center from scratch.
4 times.
Yeah.
I mean, which means it's a completely brutal environment for a startup.
It's nearly impossible.
The Riken paper actually notes this staggering bifurcation in training costs right now. So training a brand new, cutting-edge frontier model will soon cost between $18 billion and $38 billion.
Yeah, that is sovereign nation GDP territory.
Literally, only a handful of companies on Earth can write that check.
Yeah.
But on the flip side, replicating slightly older but still highly capable models on open bases like the GLM 5.2, that's going to drop to just $5 million.
The gap is just enormous.
So the giants are spending tens of billions to inch the frontier forward, while all the commodity services are just racing to the bottom on price.
Right.
And this sets up a massive danger zone.
Right.
The paper specifically identifies the 2028 to 2029 capacity delivery window as the most exposed to total financial impairment. Like the final investment decisions being signed today are the ones most likely to go bust when that window opens.
Yeah, because by 2028, this massive wave of data centers that are currently under construction will finally come online. And that's going to flood the market with compute capacity, just as those commodity AI models are driving the price of that compute down to near zero.
Okay, let me push back on the doom and gloom for just a second, though.
Sure.
Are we looking at this as if demand could just completely evaporate? Because surely there is inelastic demand here, right?
Yeah, that's a fair point.
Like there have to be some uses of AI that are completely immune to price sensitivity, where governments or massive industrial sectors will just buy compute power no matter what it costs.
Well, if we step back and connect this to the broader geopolitical picture, you are absolutely right.
Okay.
The Riken paper doesn't predict zero demand. They actually specifically identify a sector they call AI for SIs.
Which stands for it?
It stands for AI for Science and Industrial Innovations.
Gotcha.
And we're talking about mission-critical, sovereign-level capacity here. This is computational power dedicated to things like pharmaceutical drug discovery, advanced materials engineering, and, national defense.
Right, stuff governments will always fund.
Exactly. That demand forms an inelastic floor. It is foundational, and it really isn't going anywhere regardless of what the broader consumer market does.
Right.
And this is the really critical caveat, that sovereign demand may only be enough to sustain the core incumbents.
The big guys.
Right. It likely isn't enough to save the highly speculative, heavily leveraged edges of the market. And those edges are the entities currently driving the massive bubble in data center construction.
Okay, so let's play this out. If the industry accidentally steps out of that narrow solvency corridor, like if that 2x growth just doesn't materialize, how does a bubble of this size actually pop? Let's walk through the domino effect, because it starts with a drop in inference spending, right?
Precisely. So period one, cash flow uncertainty. Corporate and household spending on AI inference services, the actual daily use of these tools just fails to meet those really aggressive projections.
Okay.
So the cash flow into the AI startups and neoclouds begins to dry up.
Which instantly creates a crisis for their lenders.
Yeah.
Because if the startups aren't pulling in the revenue they expected, they suddenly realize they cannot amortize those massive 3 to 5 year loans they took out to buy the GPUs.
And that inability to pay the hardware loan is pretty much the match in the powder keg.
Right.
Because once they default on the GPUs, they simply go bankrupt and they break their operational leases.
Which leads to period 3.
Exactly, which creates sudden, massive tenant churn. You abruptly have these colossal, energy-hungry, physical data center buildings sitting entirely empty.
Leaving the data center developers holding the bag. Which drops us into the final phase, stranded assets. Because without tenant revenue, the developers themselves default on those massive 10 to 30-year term loans they took out to build the concrete and steel facilities.
Yep.
And the entire roundabout loop just snaps.
It snaps. And this raises an incredibly important concept in economics regarding how financial systems break down.
The Minsky stuff.
Exactly. The economist Hyman Minsky coined the financial instability hypothesis, and it perfectly describes the mechanics of this exact transition.
Yeah, from safe borrowing to Ponzi finance.
Right. So he outlined this shift to what he called Ponzi finance. And Ponzi finance is when a company's underlying cash flows are so poor that they literally have to borrow new money just to pay the interest on their existing debt.
That sounds sustainable.
Right. They rely entirely on the underlying asset appreciating in value or on constant refinancing just to survive another day.
Wow.
And when the music stops, when lenders finally demand real cash flow rather than just, equity pledges, the entire structure unwinds in a rapid cascading fire sale.
And here's how this Minsky moment hits you directly in the wallet. Because you might be listening to this thinking, well, I don't own a gigawatt data center. I don't trade GPUs, so why should I care?
Oh, you should care.
Right, because tech stocks now make up over 50% of the S&P 500. So if you have a standard 401k, your retirement is heavily exposed to this exact roundabouting ecosystem. Furthermore, we are seeing this massive boom in leveraged ETFs right now, meaning regular retail investors are actively borrowing money to multiply their bets on these exact same tech stocks. I mean, the exposure is total.
And the exposure actually goes far beyond your stock portfolio. It directly impacts local communities and physical infrastructure.
Yes, that was one of the most surprising takeaways from these reports for me. State and local budgets are uniquely heavily exposed to this infrastructure build-out.
Oh, incredibly exposed.
Like, take Doña Ana County in New Mexico as a prime example. The reports note they recently granted a staggering $165 billion tax break to a data center developer through industrial revenue bonds, just banking on future economic growth.
Yeah, it's a huge gamble.
And if that data center goes bust because its AI tenants default, the local town loses all the promised economic benefits, the tax revenue, and the jobs. And think about the physical power grid.
The grid is the scariest part.
Right. Utilities across the country are currently spending billions of dollars to build heavy-duty transmission lines specifically to power these massive 1-gigawatt data centers. And if the data center goes bankrupt and just sits empty, those grid upgrade costs don't just magically disappear.
No, they certainly do not.
They get passed down to the regular ratepayers.
Yeah.
You and I will quite literally see the cost of this popped bubble on our monthly utility bills.
Yeah, and I think the systemic integration of this AI boom is really what makes it so fascinating and so precarious.
Yeah.
Because the financial exposure isn't just isolated to a few venture capital firms out in Silicon Valley, It's woven into municipal bonds, it's in public pension funds, and like you said, it's literally built into the physical electrical grid itself.
So to summarize the incredible tension of this moment we're in,
Yeah.
we are watching an unstoppable force, these multi-year long-term agreements and massive technological leaps in computing power colliding directly with a highly fragile circular financial structure that is sitting atop incredibly fast appreciating assets.
That's the perfect way to frame it. It is fundamentally a race against time.
Yeah.
The industry has to invent the future fast enough and generate enough real-world utility to justify the staggering debt they took on to build it.
Which leaves us with a kind of mind-bending hypothetical for you to ponder.
Okay, let's hear it.
Let's assume the worst-case scenario for the speculative edges of this market, right? The bubble pops.
Yeah.
A massive AI data center goes bankrupt, and the GPUs inside are just liquidated for pennies on the dollar.
Right.
What happens to the dedicated nuclear power plants, the heavy-duty transmission lines, and the vast high-speed fiber optic networks that were built specifically to support it? I mean, they don't just vanish into thin air.
No, they're physical concrete and steel.
Exactly. So could the ashes of an AI financial crash ironically leave us with the cheap, abundant, and hyper-connected energy infrastructure needed to power the next great technological revolution?
That's a fascinating thought.
Just like the train tracks laid down in a frenzy. Right. Even if the train derails, the steel remains for whoever comes next. Thank you so much for joining us in this deep dive. See you next time.